Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me as he does each and every week, with the exception of last week. And there's been a few times in between where he's fallen off the map. Last week was my fault. He is Green Zone Fortunes co-editor Charles Sizemore, and we are here with an episode of Investing with Charles. And Charles, dive right in. I do want to remind everyone that if you do have a question for me or for Charles or even for Adam O'Dell, our chief investment strategist, you can email us. Our email address is feedback@moneyandmarkets.com. We'll drop that right down below, or you can comment down below here on our YouTube channel. Now, let me jump right into it. Over the weekend, big stuff. Investors either flocking to Omaha, which very rarely ever happens, except for this one time a year, or they are tuned in on whatever streaming platform is able to get a camera inside, and that is for Berkshire Hathaway's annual shareholders meeting, and
also known as the Woodstock for capitalism.
Yes, the Woodstock for capitalists, but more importantly, just to hear remarks from the Oracle of Omaha himself. And I don't really want to talk about that because he covered a lot of ground. He talked about, the market in general. Charlie Munger also talked about the market in general, kind of being turned on its ear. There was discussion of crypto,
Buffett
which
also said that the market had become a gambling parlor.
Yes.
I'm shocked that the market, I know that Warren Buffett is a wise man, but once in a while, he'll say something that's just obvious. And you don't have to be the Oracle to acknowledge that the market is, in fact, a casino.
Yeah, exactly. So, I don't want to talk about that yet. And I don't want to talk about their take on crypto, because I think that's a whole other video that we could do at some point in time, is just to get Warren Buffett's thoughts on crypto, which were made very obvious.
He pulled no punches on that one.
No, he did not lay back at all. But what I do want to do is I want to talk about some of the moves made within Berkshire Hathaway's portfolio that were also unveiled during this meeting. And I'll start off by we can talk about Berkshire Hathaway. Let me pull up a stock chart of Berkshire Hathaway as of right now. The stock has reached a 52-week high back in March. It has dropped a little bit. It's about 14% up over the last 12 months. It is, still beating the pants off the broader finance sector. It is also, the stock is trading below its 50-day simple moving average, but I think a lot of that has to do with the big run up it had into March and then the subsequent market headwinds that has pushed that stock back down now into more, I guess, what you would call realistic territory. And in terms of ratings, Berkshire Hathaway rates a 95 overall on our stock power rating system. We've got a 94 on momentum, as we saw that big uptick leading into the March 52-week high. Volatility is at 97 because this stock relatively moves without a lot of bounce. It doesn't really pare back a ton.
That's really part of the appeal of Berkshire Hathaway, is that this is a stock that is just rock solid, a balance sheet that is unassailable. It is a company that should survive the apocalypse. Like post-nuclear war, Russia finally hits the button and nukes us. It's going to be a world of cockroaches, rats, and Berkshire Hathaway. These are going to be the three things that survive.
What an interesting party to be a part of. Also, Berkshire Hathaway it rates a 95 on our quality metric, 89 on growth, as this is the company that continues to show very strong growth metrics. Values at an 81. I think we see that kind of come back. That's going to come back up a little bit with this recent backslide of the stock due to headwinds. Size is a 1.5, but again, this is a massive company, so it's to be expected. When we can kind of discount size, especially when we have our other five factors that score Berkshire Hathaway that well. So it is a very, very strong stock, and I agree with you. I think it's going to maintain that. But what I want to do is I want to first start off with probably the biggest two stocks that were talked about in terms of Berkshire Hathaway. The first one being Occidental Petroleum. And this is obviously it's an oil and gas company. I'm not sure exactly the percentage that they increased their stake in, but it was significant enough to really draw out a lot of the financial media. And if we look at Occidental right now, in terms of our stock power rating system, it's a 79 right now. We're bullish on it. I think that it's going to beat the market by at least 2 times over the next 12 months. It's got strong momentum, strong growth, both rating in the 90s in both of those. It is a big company, so obviously size is going to take a hit here. Value and quality kind of in that mid-range, but still strong. Volatility is a bit is kind of in that neutral area, and a lot of that is because we've seen energy stocks move quite a bit lately, especially when we have the Russian invasion of Ukraine. We've got inflation, we've got prices ticking up in terms of across the board. So we are going to see a little bit more volatility in terms of some of these energy stocks. We look at the stock chart here. Occidental is up about 123% over the last 12 months. And it is, whereas the broader energy sector is only up about 54%. So Occidental is very strong, especially compared to its peers. So let me first get your thoughts on Occidental and Berkshire Hathaway's move to increase its stake in the petroleum company.
Before I do that, let's get a bit more big picture. So, our stock power rating system is divided between 3 technical indicators and 3 fundamental indicators. And of course, there's sub factors that drill down deeper. But at the end of the day, it's roughly half fundamental, half technical. So we always assume Warren Buffett is the fundamental guy. He's the valuation guy. He doesn't look at stock charts. He doesn't really do technical analysis. Yes and no. So Buffett is not a chart guy. Like he kind of dismisses that aspect, but he does focus on one aspect of technical analysis. Actually, he has had over his career a pretty strong preference for low volatility stocks. What he figured out a long time ago was that you find good growth stocks that have a long runway in front of them. You buy them at a reasonable price. And you tend to focus on those that tend to have lower volatility, and you could kind of leverage that up with your insurance float. So that was basically Berkshire Hathaway's gig. Was he had this insurance float money to play with. He kind of bet the farm on good growth stocks trading at a reasonable price that don't move that much. Like that was kind of his bread and butter trade there. So it's interesting. Occidental basically fits that mold, and Buffett really has pivoted towards. It's funny. He made a couple significant pivots over the last couple of years. One is, we'll talk about this in a minute, was he made a big pivot to technology, which was something that he's never really done before up until fairly recently. And then secondly, over the last couple of years, he's really pivoted hard to energy. And I think that was, I think the proof is in the pudding. That was a good move. He's done well in Occidental, and I don't see him getting rid of it anytime soon.
And the other one here that drew some oohs and ahs a bit was his increased stake in Chevron. Chevron, another big energy player, big oil and gas player, is dipping its toe a little bit into renewables with some recent acquisitions. We've talked about that in a couple articles written now on moneymarkets.com. You can check those out. But right now, Chevron a 93 overall on our stock power rating system. Very, very bullish.
It's
very
killing
strong
it.
Bullish on this. It is. And momentum is massive. It's in the top 1% of all the stocks that we rate. It's at a 99. Volatility is at a 92. Now, remember, if you're looking at our metrics on the website at moneymarkets.com, a high volatility score means it is a low volatility stock. So just bear that in mind, that if you see a high volatility score, that doesn't mean it's got high volatility. It actually means the opposite. It means it has low volatility. And then fundamentally, Chevron, very solid, 88 on growth, 84 on quality, and 79 on value. So again, this is out of the two. I mean, Chevron, according to our metrics and our analysis, Chevron stronger out of the two between Occidental and Chevron. And if you look at, we will pull up the stock chart for Chevron. Chevron up about 58% over the last 12 months. It is not performing as strongly against the energy market as Occidental, but it has considerably less volatility and that upswing to that 52-week high it reached in mid-April. So, again, Chevron very much an upward steady eddy, if you will, whereas Occidental has seen a little more bumps and bruises along the way. So your take on Chevron here for Berkshire Hathaway's portfolio?
So Chevron is, an integrated major. Like they do everything. They have they explore for oil and gas, they refine it, they move it, and they sell it in gas stations. Like they do everything, and that makes them a much less volatile business, which is good. That does actually fit the Berkshire Hathaway mold a bit better of buying low vol growth stocks. So that's it's not shocking at all. Now, Buffett also has shown this tendency over his career to be greedy when others are fearful. Nobody wanted to touch energy with the 10-foot pole, except, I might add, Warren Buffett and our team here
That's right.
You, myself, Adam, we've been bullish on energy for a while. Apparently, we're an elite company with Warren Buffett, but nobody wanted to
feeling pretty good about myself about that right now.
Feeling pretty good,
real good. Feeling real good about that.
Nobody wanted to touch energy, and Buffett was one of the first big investors to really go in, really jump in with both feet. So it really goes to show being independent, being willing to kind of look beyond the fears dominating the market today, look at the numbers, be objective, just keep a level head. Actually, one of the comments that Buffett made in his lengthy comments in the annual meeting was, investing is not about intelligence. It's actually about temperament. Intelligence is important. You can't be mentally handicapped and be good at this, but you can be of average intelligence, but with the right temperament, you can be an excellent investor. So, that goes to show, why was Buffett willing to buy Chevron when nobody else wanted to? He has the temperament.
Yeah. And I think the other thing here to look at is that you have to take emotions completely out of the game here. You when you're looking at a stock to buy or a stock to sell, obviously you're going to be inundated with headlines and other points of analysis or knee-jerk reactions and things like that. I think the point about temperament here is making sure that you keep your emotions in check when you're making an investment, because you have to look at this as your retirement, your business future, that's what you're looking at.
Well, it comes down to why do people generally have the wrong temperament? It's because they set things up in a way that they put themselves in a bad position. Warren Buffett has the ability to have the temperament he has because he structured Berkshire Hathaway not as a mutual fund where investors can freak out and demand their money back tomorrow. He structured it as a holding company, where if I'm no longer happy with Berkshire Hathaway, I sell the shares on the open market, but I don't claw the capital back from them. Whereas if you sell mutual fund shares, the manager actually has to sell some of his investments and write you a check. Well, no one actually writes checks anymore, but you get the idea. When you liquidate a mutual fund or a hedge fund, the manager actually has to sell some of their investments and cash you out. So Buffett knew that. He never wanted to be in that position. So he structured his company in such a way that he would not have to ever do that. People can buy or sell his stock, but they never redeem. So, that's professionals. It's one of the reasons why a lot of professional investors have, even though they're pros, they have terrible temperament because they're structured in a really bad way. Now, as individual investors, we don't have those constraints, but we can still do really boneheaded things that cause us to lose that perspective. Having a position size that's too big to start with, if you're just having too much of your capital at risk, having too much in the market or having too much in a single stock is going to make it really hard to stay emotionally detached, to stay objective. So if you want to be like Buffett, you want to be, cool hand Luke here and never let them see you sweat, whatever. I'm mixing metaphors, but you get the idea. If you want to have that Buffett demeanor of not getting nervous, not getting scared, the key is don't over leverage your portfolio. Don't have so much at risk that you're going to start getting that feeling in your chest where you freak out. Just simply having that right portfolio size where you can sleep at night. That's step one to becoming like Buffett.
Another stock to take a look at here that didn't really draw a ton of headlines, but I think it's one that bears mentioning that's in the Berkshire Hathaway portfolio, and that is Coca-Cola. This is the Coca-Cola company on our stock power rating system. It's a 67, which is a bullish outlook. Very strong volatility, very low volatility at 97. Momentum's at an 88. Fundamentally, this is probably one of the weaker stocks of the big ones that are within Berkshire Hathaway's portfolio. Quality for us is at a 79, growth at a 67, value only at a 15. It's still it's very much an overvalued stock at this point, if that's something that you're looking at. Looking at its stock chart right now, up about 20% over the last 12 months. Still trading about 3 percentage points above its 50-day moving average, and it is blowing the doors off the consumer non-cyclical sector, which is down about 5.5% as of right now over the last 12 months. So Coca-Cola, interesting. I think this has been a long-term play for Berkshire, if I understand correct, if I remember correctly.
He started buying
Coca-Cola for a long time.
Since the 80s. He started buying Coca-Cola aggressively in the 80s. And why? It's the same Buffett formula. He bought a stock that was, a good, consistent growth stock that had low volatility. And he took a huge position in it, and he just never let go. He just held on to it this entire time. And I actually wrote about Coca-Cola fairly recently in Money and Markets. I think it is a good long-term dividend stock. If you want that low drama, just low headache, low heartburn portfolio, Coca-Cola belongs in it. I mean, it is, despite being well over a century old, it's still growing. It's still it's not growing like a tech stock or something, but it is still a very good, solid growth stock. Its quality score isn't as high as some of the others we've looked at, but it does have an excellent quality score because that Coca-Cola brand is, at the end of the day, what are you selling? You're selling sugary water with bubbles in it, right? I can go make my own, Coca-Cola in my garage and slap a different label on it and try to sell it. And it might taste better than Coca-Cola, but it doesn't have the red logo, right? And so it doesn't have recognition. That brand, that branding is other than McDonald's, golden arches and maybe Mickey Mouse ears. I don't know that there is a more powerful brand anywhere in the world. So I think it is a nice stock to hold forever. I mean, it's not cheap right now. It's actually quite expensive, but this is a stock that rarely goes on sale. You're never going to get rich in Coca-Cola, but it is, if you want a low drama stock to just throw into your dividend portfolio, collect that dividend every quarter and just not worry about it, Coke's your stock.
2.77% is the dividend yield on Coca-Cola right now. So it's not the highest. It's certainly not the lowest, but it is strong.
It's competitive with bonds. The 10-year treasury is touching 3% right now, and Coca-Cola's dividend is within rounding error of that. The difference, of course, being if you buy a bond today, you're never going to see an increase in the coupon payment. Whatever yield you buy today, that's it for the life of the bond. Whereas with Coca-Cola, they raise the dividend every year. I want to say it's 60 years in running, they've raised the dividend. So, and think about what the last 60 years have looked like. It's been one crisis after another, one, chaotic episode after another. And yet they just keep chugging along, raising the dividend. So, what would I rather have for what would I rather trust my retirement to, a 10-year treasury or Coca-Cola dividend? I'm taking the Coca-Cola dividend. It's more likely to actually grow with the rate of inflation and be there for me when I need it.
Exactly. Last stock, take a look at this one is a little intriguing. You touched on this a little bit about Warren Buffett and Berkshire Hathaway kind of dipping their toe in the water when it comes to tech. And one of their big tech holdings is Apple, AAPL right now. And Apple has had some struggles. We've seen some supply chain problems with some of their product rollout. Obviously, they had been reliant on China for product. That took a big hit in 2020, and that supply chain issue continues today. Semiconductor shortages are hurting Apple a bit. It's not stopping them from releasing products and making millions and millions of dollars, but it is impacting
millions. Millions.
Okay. Yeah.
Okay. Well, add a couple zeros to that.
I was thinking more on a quarterly scale and not necessarily on an annual scale, but that's fine. Billions is fair. It's $2.5 trillion market cap. I think it is still the largest, or if not number two, in terms of
it's
market
slugging
cap
it out with Microsoft. I mean, it
goes back and forth depending on the day. So right now, Apple is rates a 66 on our stock power rating system, which is bullish. It does score very well on quality. It is a very good quality stock. Top 5% of all stocks we rate on quality at 95. It's got a momentum score of 79. We'll show you the stock chart here in just a second. Volatility is at 78, all in the green. Growth is at a 72. Of course, the stock, the company fundamentally has grown year after year after year. Value, again, kind of like Coca-Cola, it is showing a lot of signs of being overvalued. But in terms of large stocks in the market, you'd be hard pressed to find ones that aren't. And then size, obviously, it's going to score very low here because it is either the largest or the second largest company by market cap trading today. And as far as the stock
not exactly a small cap.
No, not even close. not even by a little bit. Right now, Apple is trading about 20% above where it was 12 months ago. It is slightly lower than its 50-day simple moving average because it did have a lot of time between December. It got its traditional fourth quarter bump. This is, the fourth quarter bump for Apple is when sales come out, they release new products. You have holiday sales, product sales usually go through the roof, and investors become very, very happy with Apple. And that's, happened again during this fourth quarter and into the first quarter. It touched its 52-week high right around just after the start of the year. It bounced a little bit, testing some resistance, and then has paired back with a broader tech sell-off, but it's still 19% up. And it's blown the doors off of tech on the broad scale. The tech sector is down about 2.6% as of right now, as of us recording it, whereas Apple's up 20%. So you've got a big swing there. But this is an interesting play here because tech used to be something that Berkshire Hathaway really didn't want a part of.
Well, no, this was a bit when Buffett started buying Apple aggressively, people took notice. They said this is unusual. It's Berkshire Hathaway hasn't bought tech in. There's been onesie twosies where Buffett made investments in tech, but very, very few. And the fact that Berkshire Hathaway went so big into Apple, and they're one of Apple's biggest shareholders now. Their position is absolutely enormous. Like Berkshire Hathaway can't sell Apple now. Their position is too big. They're in for the long haul at this point. Like they couldn't sell if they wanted to. Their position is too big. So that Buffett doing that really is almost like this blessing that, okay, you're a large company, you're part of the institution now. You're not some fly by night tech that's going to roll over and die tomorrow. You are here for the long term. That's obvious. I mean, it's the Apple mobile ecosystem is not going anywhere in our lifetimes. No. So, but it is interesting that, when Buffett gives it his blessing, that's a big deal. So, looking at Apple, I think it is noteworthy that Apple has managed to survive this. So many tech companies have gotten their clocks cleaned over the last. I mean, it's just, like a Tyson Fury punch to the face here is the general experience of a tech company in 2022. Yet Apple has managed to stay, it's down from its highs, but it's not down that much. So right. I think it is interesting that Apple's managed to hold its own like this. Now, what's next for Apple? When your market cap is over $2 trillion, do you really expect to grow like a young company? Probably not. But the way I look at it, if Berkshire Hathaway has made it a major mainstay of the portfolio, it's probably something you're okay owning.
And it does have, I believe, a 0.58% dividend yield.
Don't spend all that in one place.
Yeah, don't expect to go buy property here in South Florida on that dividend payment. But again, it's a nice added benefit to owning what is a very large company that's not going to go anywhere anytime soon. So overall, that's what I want to look at and get your take on each one of these four stocks, Charles. But I guess at the end of the day, your biggest takeaway from the annual meeting this weekend.
Oh yeah, biggest takeaway is look at Buffett. Look at the man. He has managed to become the legend because he had a plan and he stuck with it. So the key is not to copy Buffett's plan, because Buffett's plan, he put this together in the 70s and he saw it through to completion. The world is different now. If Buffett were a young man, he would not follow the exact same roadmap he followed over his life, because it's a different world now. But the key is have a plan and stick to it. Find a plan, do your work, do your research, make sure it's a good plan. Of course, don't just a bad plan is don't find a bad plan and just run it into the ground. But find a good plan and stick with it. There's going to be times where it's difficult, but stick with your plan and have discipline. Follow that model, follow that plan, and you will be successful. We can't all be Warren Buffett, but we can be successful.
And if you are struggling to maybe find out what that plan should look like, I encourage you to check out Green Zone Fortunes. Again, Charles touched on it. Adam, Charles, myself, our entire team, very bullish on energy, even before it was in vogue to be bullish on energy. So, we've got a lot of great plays in the portfolio right now. We do provide you that roadmap. We provide you that analysis. It's all right there. We'll put a link up top here to where you can find out more about Green Zone Fortunes. Also, I did show you several, charts showing our stock power rating system. If you want to learn more about that and get into our stock power rating system, you can do so at moneyandmarkets.com. Up in the top right-hand corner of the homepage of the website, you can type in a ticker or a company name, and you can pull down all sorts of great information, including how it rates overall, of the breakdown of our 6 metrics that we use to rate it. You'll see, stock chart, fundamental analysis, some fundamental data on the company, as well as any of our analysis that we've written on Money and Markets. It's all right there. You can use it for free at moneyandmarkets.com. And if you haven't, we don't have the sign up for it yet, but I would also encourage you to check out our Stock Power Daily. This is where Monday through Friday, I'm going to provide you one stock that rates 90 and above on our stock power rating system, and tell you why it's one you should consider for your portfolio. We send that out every morning, Monday through Friday. We'll try to get some more information on how you can sign up if you're not already. So, Charles, any other parting shots?
No, I just repeat, if you want to be like Buffett, don't try to copy him exactly, but follow the bigger picture. And that is have a plan and stick to it.
He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I am Matt Clark. I'm the research analyst for Money and Markets. And that is our Investing with Charles. Until next time, everyone, safe trading.